Our dog of the week, Foraco International, symbol FAR or FAR on the TSX. It's a drilling services company operating in 22 countries across 5 continents. The company offers not only mineral drilling, but also water drilling, which is a bit different, and they have a 265 rig drill fleet. The stock, however, isn't doing so great. It's down 25% over the past year at $2 a share and 199 million market cap, but the shares fell 11% today after the company filed its Q4 earnings. So there's your reason behind the drop, but we'll look into their earnings a bit. And really, why did the market just react so negatively to this release? Because that is quite a steep fall for it. For Q4, revenue materially fell by 30% to $60.8 million from $86.6 million, which the company attributes to a poor junior mining financing market, which we can really echo from talking to other companies in the space. It's just been a really poor market for juniors, despite really, especially on the gold price. Gold price today, it was just below an all-time high. And yet these junior companies, they just cannot do financing at this time. So drilling services like Foraco just aren't seeing the demand from that junior space at this time. As well, though, the company has exited Russia, which took a hit. They had a negative impact from foreign exchange as well as contract timing. So really quite a few things really pressuring their revenue at this time. EBITDA fell to $10.4 million from $18.7 million, reducing EBITDA margins to 70.1% from 21.6%. However, if you do remove some one-time items in EBITDA, it does improve to $13.9 million, and the margin actually did improve on this adjusted basis to 22.9% as the company has lowered SG&A. So at least the company is trying to manage its operations when you are seeing weaker revenues. The company did have GAAP profitability of 3.4 cents, which was an improvement compared to the prior year's 2.4 cents, but the improvement was primarily a shift of non-operating financial costs. Otherwise, it would have been around flat. So just generally weaker financials. But another key non-financial metric I would like to highlight is rig utilization, which really drives home the point of the weaker results. Its rig utilization rate of only 35% compared to 55% in the prior year. While there are seasonal shifts amongst other factors, of course, the utilization rate really has just dropped over the past year every quarter. I think it was 40% in Q2 or Q3, 40% in Q2, and then I think 42, something like that in Q1. Then it just hasn't done great this year as far as the utilization rate goes. You've seen just lower demand, and that's really what management's attributing to. And you can see that be reflected in the rig utilization. If we look at the geographic revenue breakdown, as it does show the general weakness across the space, generally when you're looking at these, the reason why you geographically diversify is just to lower the risk, as when one goes up, the other might come down. Another, so you don't have as much volatility in your earnings. And what we can see here is for Q4, North America was down 10%, Asia Pacific was the bright spot and it did grow by 38%, South America was down 69%, EMEA was down 59%. As I said before, the company did exit Russia, which is in their EMEA, but has also been impacted by the instability in West Africa, which we've heard elsewhere in the space. And then South America really has been the story of that poor junior mining market, and as well as some unusual delays as well. So right now you have 3 other 4 regions just doing poor, especially when you're looking at South America minus 69% and EMEA minus 59%. Now, of course, there was the impact of Russia there, which is very unusual, but just generally quite a poor overall market. And then the last thing I really want to highlight is the company doesn't have an extremely robust balance sheet, but it's not the worst either. It does have a net debt position of $61 million, which is an improvement over last year's $65 million net debt, as well as they did highlight some more higher than average working capital at the date. But when a slowdown does occur like you're seeing here, a robust balance sheet does insulate the company, but we just don't have that at this time. By no means it's an existential risk or anything like that, but it does reduce that financial flexibility. If other smaller miners in areas that they can't take advantage of other players' weakness, you can't buy them up if you don't have the balance sheet to back it up. And it just generally impairs the company's ability to navigate a turbulent market. So by no means is the company a complete write-off, but operationally it is weaker this time. The stock price has overall reflected it, and it does get our not-so-coveted award of the Dog of the Week.
That's a great summary. We do cover this segment as drillers are a great picks and shovels approach to playing a commodity boom. We've seen gold do tremendously well over the past year, for sure. And there's this is a great way to play that. You're not betting on one mining company. They get paid. It can be drilling for 50 companies, and they're getting paid regardless of whether that company hits gold, copper, or whatever. They get paid. The pick of the litter for us over the past year, and our clients already know, and we've already talked about this company, I think, on the podcast, is Geodrill. And one of the reasons we like it is the balance sheet, net cash. The growth in the business is there. The margins, the rig utilization are light years ahead of Foraco, for example. The profitability light years ahead, and it's no wonder that this share price, Geodrill over the past year, Foraco down 20% or something like that.
25.
Geodrill's up 95%. So you can look at a sector and see, we can find some strength here. Not in the junior side, but the seniors and mid tiers are drilling at a good pace right now, and that's what Geodrill is servicing. And you can see, you got 95% gains here, 20% losses. It matters what stock you pick, even if you think that this is a good sector to be involved in. We also, interestingly enough, have just released on a coverage over this past month on another company in this segment, which is probably the cheapest and really growing earnings at a high rate. I cannot speak to that company because our clients are just, buying that as right now. They've just had we've just had the buy recommendation out for about a month now. But an interesting name in that space has better rig utilization as well. They'd like to increase their rig utilization, but it's certainly better than Foraco's, which is a paltry level, really. I'm going to use the word paltry twice in one episode. That's impressive. I think it was paltry. I don't know. All right.
Yeah.
Do we have anything further?
I just think the one thing we've talked a lot in the office just about, the weak junior market despite record gold prices. And I was saying to Ryan, do we ever see it come back? I mean, even just looking since 2008, and I'm quite young, still green in the market, so I can't go much further back than that, or I don't have the experience. But I feel like the junior funding has just gotten worse and worse and worse. Do we eventually see it come back? I don't know. I know that a lot of people say that it will, but
yeah, I mean, typically when you see gold on a rise, you saw junior miners follow at some point. I think this is for your speculative capital, and people have, for decades, they put money, particularly in Canada, into this segment and have done nothing but lose money hand over fist year after year. You have these one-time spikes, but there's no way to value the junior. Most of the problem is too, there's a lot of unsavory characters in that space that are just raising money and putting it in their pockets to enrich themselves. It's a dirty little secret in the Canadian junior resource segment, and hopefully it's come home to roost and they can't do this, because it's really, to be honest, to be frank, it's disgusted me for years to watch these people, to go to conferences and see them bilking people out of money. So if many of these characters never get another dime from the Canadian investors, I would be happy. There are some great companies that are doing exploration work that needs to be done. It's just been a sector that's been tainted with a lot of unsavory characters and people who aren't really serious about exploration. They're just serious about lining their pockets. And if they don't get any more investor dollars, I'd be happy. There's some good companies that hopefully they get funded, but if they're serious about actually exploring and bringing some actual mines online, that would be great. So
I think the one thing that you also said the other day to me, and I mean it makes sense, that speculative money is just chasing other spaces now. Brett went over Big Bear AI. There's people are chasing and throwing money.
Well, at least that company has revenues. At least it has something that you can, and there's a hint of profitability. You're drilling a moose pasture in Saskatoon. Sorry, Brennan. If you're drilling on that thing, it is, it's like I'm in Vegas right now. I'd have better odds just going down there, throwing it on red or black. Like honestly, I might have more fun. I don't even gamble. Everybody, I'm in Vegas. I never gamble because I know the odds and it sucks. So it doesn't bring me any joy. I'd rather buy a great, small cap stock at a low valuation. That's not gambling. That's investing. It's easier. Yeah, and funny. But anyways, you'd be happier to do that than.
Last thing that I'll say too is just about a moose pasture in Saskatoon or like in Saskatchewan. I've literally seen, like Ryan was saying, I have seen a CEO of one of these junior exploration companies put, just under $1 million in his pocket, in pay in a year, drilling one of these moose pastures in, Saskatchewan. So it's just like, should you really be doing that? Probably not. Well, definitely not. But anyways, we've seen it time and time again. Moose pasture.
Yeah. Good companies can get founded. The rest of them can die like the sorry dogs they are. That's what I think about that sector. That's about it. I mean, there's so many good companies to put your money in and invest in, smaller, large, whatever, dividend payers. Put your money there. That's how you can grow it over time. And so I don't know if a lot of capital will flow back into the junior miners. Good companies in there that are maybe producing or have great management teams. I hope they get funded because we need discoveries, but there's a lot of fat that can be cut off there. And hopefully we don't see more Canadians losing money on some of these poor situations. So it kind of heartens me to see not a lot of capital flowing into those right now. There's a fool born every minute, so it could happen again. I've seen it over the years.